All right, so today I wanted to give you guys a little primer on investing in real estate. This is going to be more of a beginner's guide, so I'm going to do a broad overview on many different types of real estate investing and lay out the different options for you guys without going too deep into any specific one of them. For those of you guys that are new here, I focused the past 2 years the majority of my equity position in real estate, and so my real estate investments right now are definitely my greatest asset class within my investment portfolio. So as we walk through the different types of real estate investing, I'm also going to give you guys my quick take and my thoughts on whether or not each type of real estate investing might be the best fit for you. Real estate is something that you can get creative with and you can call it whatever you want. And so there's many different types of investing in real estate. And this is just a list that I've come up with that I would say is pretty comprehensive and covers the most common types of real estate, as well as the ones that probably make the most sense if you're a beginner just starting out. Now, if you're wondering why someone would want to invest in real estate in the first place, there's a couple of key advantages that I want to just touch on before we jump into this list. The first one is that real estate is an appreciating asset, and it's an asset class that performs extraordinarily well when you compare it to other ones. Market volatility, including with real estate, is something that you can't predict, but I would say if you're looking for a long-term investment that's going to be somewhat stable, then real estate historically has performed a lot better than many other asset classes out there. The second key advantage is that real estate allows you to generate passive income. Now, I'm someone that believes that there's no such thing as real passive income because every type of income that you have probably has some sort of work involved, especially in the beginning. But at the end of the day, real estate is definitely a driver of a lot of passive income for many people. And it's definitely a great way to get started with passive income without taking on too much risk. The other advantages with investing in real estate include that you get a leveraged return on your investment because real estate is largely involved with financing. You get leveraged returns when you sell a property. There's oftentimes tax advantages, which include interest deductions, capital gains and depreciation write-offs, and other different codes you can take advantage of, including 1031 exchanges and other programs that allow you to maximize your equity position or keep your money in the investments that matter the most to you. So now that we have an idea for why real estate is such a good investment in the first place, let's jump into what the different types of real estate investing actually are and break down how you can get started in each of them. So the first one that I want to talk about that's very popular these days is flipping real estate. What flipping real estate or flipping a house is very similar to what you see on HGTV, and a major portion of what a lot of experienced real estate investors will say is a quick way to make money. The idea is that you're able to buy a home at a certain price and sell it for a higher one within a short time period and having your gross margin be the difference in between. Now that's probably the simplest way you can describe it because there's a lot of different things that go into actually flipping it, and your gross margin in flipping the property is not just going to be what the improvements are that you've done to it. There's a lot of costs associated with actually exiting the market and actually financing the deal and the costs you have to pay to actually hold the property during the time it's getting fixed. I would say that in general, for beginners, flipping a property is not the best route to go, especially when you're just starting out, because generally speaking, it does take a lot of capital because banks are usually not willing to finance a large portion of an investment, especially if it's financed as an investment property and you don't have the money to put down, let's say 20% or a significant portion of the down payment. Now, ironically, the second property that I got was actually intended to be an investment flip. This was supposed to take less than 6 months, finance the deal, hard money, source the contractors, got the work done, flip the property and turned it into great shape, put it back on the market, and interest rates went up, and here we are today. So that's a good segue into what I would say is the risks of flipping houses. While the idea is that you can turn a profit in a very short time frame, you simply cannot predict where the market's going to be in a year or even 6 months from now. With as fast as the Fed has increased the rates during this last year, the velocity at which homes are getting sold in the last year have dropped off dramatically. And if you're someone like me that's been caught up in a real estate flip when you had bought it at a market high and are now trying to sell it when interest rates are high and it's now a buyer's market, you're probably going to have a tough time selling it for what your target ARV is going to be. So once again, I'd say that flipping is probably not the route to go, especially if you're just starting out, but it is an option if you do have that equity position and are able to put in all the work, especially if you have contractor contacts and know for a fact that you're getting a property at such a good deal, whether it's off market or even on the MLS, that you have enough of a margin buffer in case something happens with the market that you're still able to sell it for a profit. There's many rules out there you can follow, including the 70-30 rule, the 90-10, whatever you want to call it. I would just make sure that you do your calculations ahead of time so that you're not caught up in an investment situation, that you have all of your equity tied up, and that you're not able to sell a property for a profit or even for break even. The second type of real estate investing I'm going to cover is rentals. There's many different ways you can classify rentals and many different things you can do to make them more profitable at the end of the day. But no matter how you look at it, a real estate investment rental is going to operate just as such. You're going to be renting out the property and collecting rents from tenants. Generally speaking, rentals are a lot less riskier than purchasing a flip, just because for one, you're usually not leveraged as much as you are in an investment flip. In a traditional purchase for a rental property, you put down the 20%, and if you finance it as an investment property, you will need to have that 20% down payment in order to secure the loan. The homework you need to do on your end before you actually purchase a rental is calculating what the rents are at market rate in the area, as well as the monthly payment you're going to have for purchasing the property at the current interest rate, as well as considering the down payment that you're putting down on the property. So let's say you purchase a home for $500,000 and the down payment is 20%. You do that and it's going to be $4,000 a month with your mortgage, your taxes, the interest payments, and any HOA fees. You then look at the market rate for rents in the area. Let's say it's a 3-bed, 2-bath house or a 4-bed, 3-bath house. What is the market rate for rents for that size property in that specific area? You take a look at the comps, and if it makes sense, especially if you'd be turning a profit just for renting it out at the market rate, then I would say you're looking at a possibility of a pretty good deal. Now, rentals are pretty solid through most markets, the primary risk being vacancy. So if you're not able to rent out your property, you need to account for a possible vacancy that you need to pay the mortgage yourself without collecting rent for those specific months. In addition, you're going to have to account for any property improvements you're going to need to make, especially if anything breaks in the home, especially when your tenants are living there. That's something you need to get addressed immediately. Another way to go about doing rentals is to buy a property, whether it's on the MLS or off market, that needs a lot of work that you already know has intrinsic value. You then make those improvements so the property's much nicer. And then once it's rented out, you're actually able to refinance the property so it's appraised at a higher value and you can refinance and take the cash out that you have in it. That's what's commonly known on YouTube as the BRRRR strategy, and something that works well, especially if you can get a property for a really good deal in the beginning and get the work done for a reasonable price so that on the back end, you can do that cash out refi and then put your money towards another investment property. The risk here is that you generally have to buy a property that's really distressed and needs a lot of work. And generally speaking, realtors or even other investors are not going to touch a property that has, foundation issues or has been vacant for I don't know how many years or just in a really bad area. So from the get-go, it's a much more risky strategy than buying a property in a great neighborhood that has pretty good comps for rents especially, and then renting it out that way. But again, that is another option for you guys out there that do have, let's say, an off-market deal that's really good, or are looking for that type of situation where you're able to put in that sweat equity and improve the property over time. Like I said at the beginning of the video, there's so many different ways you can get creative with real estate, specifically for the rental strategy. There's another way you can go about doing it, which is called the house hack. So essentially what I'm doing right now with my primary residence is a house hack. So I purchased a 3-bed, 2-bath house, and it's financed as my primary residence because I do live there. And what I've done is I've rented out the 2 other rooms that I don't live in to tenants that pay me rent every month and help offset the mortgage payments. Now, due to the recent tax assessment and the property value going way up from what it was, the rent I'm collecting from my tenants is no longer going to cover the entire mortgage payment. But that being said, it can minimize or even reduce your monthly payment to 0 for owning a property just by having other tenants living in the property with you and collecting rent at a market rate or a reasonable amount of rent. I'd say house hacking is also fairly common these days, but it's definitely a strategy that works, especially if you're a newer investor, just because you can use a different financing strategy to put less money down and then use the income you're getting from the rents in order to help make those monthly payments. At the end of the day, all the rent you're collecting is going towards the equity that you have in the property. So 10, 20 years down the line, once you have 100% equity in the property and you own it free and clear, then you can rent it out for whatever you'd like. And all the money that you're making would be directly passive income. So the next one I want to talk about is syndication. What I mean by syndication is going in on a real estate deal with other partners that you're investing with. And the difference is going to be who are the general partners and who are the limited partners. The idea here is that you're able to purchase a property that's sometimes a commercial property, which is a big difference also from residential, in that a commercial property has 5 or more units and residential is 1 to 4. Generally with commercial properties, we're talking about, let's say, an apartment complex. Let's say it has 33, 40 units. It could be upwards of $10, $20 million. Generally speaking, most people, especially if you're just starting out in real estate investing, are not going to have the equity to put a down payment on a $20, $30 million property. Now, in order to buy that property, if you go in with other investors and you syndicate the money so that essentially all the investors are pooling their money for that down payment and they're splitting the returns on their investment, whether that be through rents or whatever they're doing to increase the net operating income of that property. Now, syndication is definitely popular among investors that are a little bit more established and have a better equity position because it also lowers your risk portfolio as you're not the only investor that has the most significant equity stake in a property. That reminds me of another benefit of investing in real estate, and that's that it's a hedge against inflation, especially when you're not the sole investor in investment property. Generally speaking, the real estate market outperforms other asset classes in the long run, as we just talked about. And instead of having your money parked in the bank, Assuming that your property is appreciating in value, you're getting more equity in your property just from owning it and not losing money through inflation by having the money parked in a situation where it's only making 1 or 2% every year. So the next one I'm going to talk about is REITs. So this is real estate investment trusts. There's also real estate investment groups, but I'm just going to lump them together because they're really not that different. In terms of the types of returns you're going to see as an investor, I would say they're fairly similar. And for REITs, it's almost like investing in a broad market index fund or an ETF, because generally what it is that a company owns a lot of income producing real estate, which can include commercial real estate like office space, apartment complexes, warehouses, shopping centers, you name it. And instead of actually having to engage in each real estate deal yourself, you're investing in the REIT as a form of a stock. And generally they pay out dividends every month or every quarter, just like a regular stock would. Again, the returns on this are generally pretty moderate, and you wouldn't see, 30% appreciation in a year like you would with the property in 2021, or the ridiculous gains that you might make from flipping a property and making, 20, 30% on your initial investment. But again, REITs are a way to invest in real estate without actually being hands-on with having to engage in the actual transaction of buying and selling real estate. The last one that I'll touch on briefly is just online platforms. So there's things like Fundrise where you can invest in real estate with other partners. So it's almost similar to syndication, except that it's online. And so many people can access this platform. And so your equity stake would be a lot lower, in addition to your risk portfolio being a lot lower. But again, generally speaking, the lower your risk portfolio, the lower your possibility of a great return, as goes with investing in individual stocks versus broad market index funds. So if we look back at our list of the different types of real estate investments, I would say if I were to rank them in order from most risky to least risky, I would say it's definitely flipping, then rentals, then syndication, and then REITs, and then online platforms. In that same order, I would say that with higher risk is the possibility of higher return on your investment and higher reward. But again, if you're just starting out and investing in real estate, or if you don't have a ton of equity and you're trying to build that up and then invest in more real estate, I would say that the best route to go down in the form of a real estate investment in terms of this list would be some form of a rental. Whether that's through house hacking and offsetting your mortgage payments through collecting rent from your tenants, or just buying a turnkey property, putting 20% down and renting that out for the long term. If you purchase it in a great area, you can usually bank on pretty good market appreciation over the long term. And as you build equity in a property, you can then do a cash out refinance once you've gotten enough equity in it to then put that money towards another real estate investment. I would say in terms of my strategy right now, well, number one, it's to sell the condo that I have in San Francisco that was supposed to be a real estate flip. That's going to cost me a lot in terms of the monthly payments I'll have to make, even if I do rent it out, because the mortgage payments are already a lot higher than what the market rate is for rent. But more or less, I pretty much am forced to turn that into a rental because it's currently not selling. But once I've built up more of an equity position, I do really want to focus on sourcing off-market deals, especially with distressed properties that need a lot of work, because to me, there's a lot of fulfillment in turning a property that's really not that great and needs a ton of work into something that's really nice and I would want to live in myself, in addition to the fact that I'm building forced appreciation and my equity position in the property at that point. I would say that I'm never selling my primary residence because I bought it in a great area in a great neighborhood for a reason, so that over time I'll be able to build my equity position in that property just by renting it out as well as living in it myself. So I hope you guys found this video useful. If you did, drop a like down below. If you guys have any questions, leave them in the comment section below and I'll do my best to answer where I can, especially when it comes to investing in residential real estate and possible pitfalls of both flipping and doing rentals. I'll certainly be keeping you guys updated on the way my real estate investment portfolio evolves in the future, or if you're interested in possibly investing together, do let me know. I'm always interested in the prospect of working with a partner. But until next time, thank you guys for watching and I'll see you all in the next one.